Hello, welcome back. As we have talked in the past, it's been about 2 months or so. Best Buy is a very interesting retailer to be holding right now. And I myself quite like the stock. I've talked about it, although I'm always a little bit wary about the current situation in the markets, in the overall economy, really. And this can potentially hurt retailers, at least for the short term. However, Best Buy is a company that has great financials, and it came out with its earnings report yesterday, and you will see that it's up 5% right now in as the market pretty much opens for the day. Now we will examine exactly what happened. We can first take a look at our stock news module here, and you will see that Best Buy reports better than expected Q2 earnings, rallies after profit, revenue, and same-store sales fall, however, but beats expectations. So things were expected to be bad. I mean, we kind of knew about this, but when you are getting better than expected results, you can still beat expectations and do rather well. Now you will see here that Best Buy's sales dropped by about 13%, and the consumer electronics company had already cut its full year forecast in July. And the retailer is seeing a noticeable shift in spending as people go back to the office, juggle the costs of summer vacations, or skip big ticket items as they pay more for necessities. Something that again you would expect in this current market pretty much when people cut down on spending expectedly and interest rates are going higher. Okay, Best Buy said that sales dropped by 13% is what we said over here, and earnings per share were 1.54 adjusted versus 1.27 expected, which is a pretty handy beat over here. And they beat rather strongly here in EPS. In terms of the revenue, they did 10.33 billion versus 10.24 billion that was expected. So still better in terms of revenue as well. Now you will see that we're having softer sales and more promotions here, and that could potentially, I'm assuming, mean that we're gonna have some dropping margins here. Again, kind of to be expected as we are entering a phase in the economy where people will be cutting down on spending here. They're gonna be buying like less expensive items for the most part, and this tends to have a decline in terms of margins for companies when this happens. Now, you will see here that the retailer has noticed some shoppers are trying to stretch the budget. Some, especially from lower income households, are trading down to lower price TVs or timing purchases for sales events, told investors on earnings call here. As you can understand, this is another potential information, potential notice here that we are potentially heading in a recessionary environment, at least for a little while, where people are actually cutting down on more expensive items in order to buy more budget items here, which is interesting to see. Now, Best Buy has also spent 34 million on a restructuring effort here, spent on termination benefits, and expects more in the upcoming months, pretty much. Okay, shares have been down overall, of course, expected in this overall economy, and this is why it may be a potentially interesting buy. And we have talked about this fact. When we're actually entering retailers are generally pretty risky when we're talking about potentially recessionary environments. But if we can buy them at a very cheap price and buy ones that are solvent, they don't have a lot of debt, and they manage their inventory pretty well, then we have a win in our hands. And this is why we're looking at companies like Best Buy, again being down significantly from 142 almost bucks a year ago. You can take a look at the 5-year chart, and you will see the usual story that we're looking at with stocks right now. Everything has been going high and then all of a sudden going lower. Again, something that is very typical these days with stocks. Now, the PE ratio of the company is sitting at 8.6 and the price to free cash flow at 7. Another great thing to see, very low and very converging, pretty much very similar to each other. So this means that the company is, generally speaking, producing similar free cash flow compared to the net income that they generate, which again is a great thing because profitability turns to free cash flow. There's not much trickery going on potentially. In terms of outstanding shares, it's going down as well because the company is buying back shares, and pretty typically buying back shares every quarter over here, which is great to see. Again, as an investor, you love to see that because now your stock is worth more, and so I love to see that as well. Great stuff. A little bit of extra debt compared to the free cash flow, but not too much. like 5.7 years of free cash flow pretty much required last year's free cash flow to pay back all the total liabilities, which is fine. I mean, this is not a big number here. And in terms of revenue growth, it keeps increasing, net income growth increasing as well, free cash flow increasing too, and it's only the total equity growth that is going down. But remember, the company has been buying back shares. When you do that, you are spending cash, and when you are spending cash, you are reducing your equity. And so this means that total equity can go down, but it's a good thing as long as you are spending wisely. And I think the company does spend wisely here, buying back shares, because it looks like it's pretty cheap, and we will see that with our tool later, our stock evaluation tool. We'll examine the exact price and why this is cheap potentially for the company. Now, the return on equity is rather high as well, as you can understand, because again the equity gets dropped here, kind of artificially. You could think that this number is actually elevated here, and you have a point. And this is a very, very known thing about the return on equity. When the company is buying back shares, they can actually artificially increase this number, because now they're spending money in order to buy this outstanding shares, reducing their equity. Another thing that they can do that is by actually getting more debt. But it looks like the company is doing that mostly by actually getting more shares back in the open market. And this is why the debt to equity ratio, although it's a little bit high, is not that high. It is still high though. I mean, they do have some debt over here. Now, the margins have been a little bit suppressed, as you can understand, very understandable for the company, but I love to see the dividend yield in comparison to the payout ratio here. We can always take a look at our dividends tab, which kind of gives us a full picture of what is going on with the dividends of the company here, like quarter by quarter. You can see exactly what is going on. But right now, at this current price, we're looking at a 4.5 dividend yield, which is very, very lucrative, as you can understand. And again, if you go back and take a look at the metrics here, you will see that in terms of the ratio, of the payout ratio, this is 28% of their free cash flow and 40% of their net income, which is great. This is very, very solvent here, so the company won't be having problems serving this dividend for a while. And this is exactly what you want as a shareholder. And remember, this is a 4 when we're talking about the last 12 months, but if we're talking about the current price, is a 4.5. Is a little bit more elevated because the stock has been going down in terms of its stock price overall. Okay, so let's take a little bit of a look now at our stock evaluation tool next. Actually, first let's take a look at the financial statements, because I haven't, and it's interesting to see the 42 to 51 billion increase in revenue. Company is still increasing revenues, not at an incredible pace, but still increasing them at a nice pace, and that's nice to see. This is a very, very big company as well, and a retailer too. And net income from 1 billion to 2.4 over here. In terms of its balance sheet, you will notice that 3.6 equity become 3 in terms of their total equity here. But remember, the company has been buying back shares like crazy. And in terms of the cash flow, you will see here that 2.4 billion in net income result in 3.2 billion in operating cash flow over here. Some adjustments as usual, some spending in inventory over here. Again, that's all things that are to be expected as long as the company doesn't overdo it. They don't seem to be overdoing it. They actually seem to be cutting down on inventory a little bit, inventory spending, which is wise. Now, in terms of their investing activities, spending 1.3 billion here, mostly in capital expenditures, as you'll see, and like in equipment, property, plant, and things of that sort, and some investments, very normal stuff. In terms of their financing activities, spending about 700 million in dividends that are paid over here, back to shareholders, and repurchasing common stock, what we love to see over here. Again, great stuff for the company. And remember, the free cash flow is 2.5 in terms of the total that they made last year, which is less than what they made 2 years ago, but still, compared to the dividends that they're paying, it's like 30% or so. So this is great. I mean, the company is actually great in terms of free cash flow payouts here. Very, very solvent, and they can very, very easily pay their dividends as well, making this amount of free cash flow here. Now, again, this can be hurt for a little while. Again, at this current economy, it could be hurt for a little while, but the company doesn't seem to be having lots of troubles, even if that happens for a year or two even. Okay, so what about our stock evaluation tool? What's up with this one now? Now, the company has been growing at 5, 6, and 9 over here in terms of the 5, 3, and last year averages, and we're going to use less, like 1, 2, and 3% here, and see what is going on with this one. In terms of net income margins, about 3 to 4% is the norm here. So I'm going to go 2, 3, and 4 in between these numbers. And in terms of the free cash flow margins, close to 100% is the typical one. Some years a little bit more, some years a little bit less. Typically more than 100%. So I'm gonna go 100%, 105, 110 here. And in terms of the annual return, I'm gonna go 13%. So let's see what we're getting with these numbers. And as you'll see, with these numbers of cautious, very cautious revenue growth, very cautious net income margins here, we're looking at projection results that are mostly a buy for Best Buy. And it's only our low ones with a 1% revenue growth, which is very little, frankly. And this is extremely conservative here. And still we are a red here, but not too far from the current price. Still, it is a red for a revenue growth of 1%. Again, I don't expect this to happen. Even 2 or 3% is probably quite little for Best Buy for the next 5 years. But even if that happens, at 2%, we're sitting at 104 over here. And this is a buy, a pretty easy buy at that. And you can understand that just a minor increase in revenue growth here makes a ton of difference in terms of the actual price to pay for this company. And that's because they are very, very good with generating free cash flow and net income here, which compares very well to what they are doing in their revenue numbers. And so this is why an increase in revenue actually has a pretty steep increase in the company's price to pay today based on its current price. So that's what I wanted to talk about in terms of this one. A very interesting company, an interesting retailer, which I think is a buy right now. And yeah, you need to be a little bit cautious with retailers, but I think this one could be a buy for a potential long-term hold. And thank you for watching the video. I hope you enjoyed it, and I'll see you in the next one. Remember to like and subscribe in the meantime, and take a look at this video that I made earlier about Vinco Ventures, an interesting company that is potentially squeezing. It's trendy. Take a look at this one just to see some of the finer details, and I'll see you in the next one. Bye bye.